Welcome everyone to Peak Market Watch. I'm Sandra, and sitting here's my co-host Cedric. Today we have a lovely guest, Vessi Kapoulian, and I got that correct?
Yes, you did.
Oh, good, good. We've known Vessi quite a few years. I want to say 3. Does that sound about right?
It's been some time now, yes.
Yeah, I can't remember exactly where we met Vessi, but we're all entrepreneurs and we tend to go to a lot of the housing conferences, multifamily conferences, syndication conferences. So we met you somewhere along the lines and we've stayed in touch.
Absolutely, yes. It's a very small world, so easy to cross paths.
That is true. That is true. We feel like it's a large world, when you're out there doing it, but in the scope of things, it's not. So, Vessi, when we look at your LinkedIn profile and the conversations we've had, you have a fascinating background. You mentioned growing up behind the Iron Curtain. Could you tell us a little bit which country and what that really means?
Yes, happy to share. So I'm originally from Bulgaria, and not only did I grow up at a very different place, but also at a very different time. When I was little, Bulgaria was still under the communist regime, and that's what I am referring to when I say behind the curtain, where Europe was divided into East and West. That time has long gone, but I share that because as especially today as an investor and an entrepreneur, some of the um, habits and knowledge I developed at that time, as far as not only being fiscally responsible, not spending more than what you have, but also at the time when people discussed investments, there was not a stock market or developed stock market in Bulgaria. So very often they refer to hard assets. And so I share that because that's when looking back at my own journey, I think that's when the seed of real estate was really planted in me.
Yeah, I only know a few other people that are from a similar background, communist background, and they definitely share a similar sentiment. They're very focused on hard assets. What we enjoy here in the United States or the Western world is really something very novel to them. I guess you get used to it.
Yes, absolutely. It's um, like with everything, there are pros, there are cons. So I don't necessarily want to go back to that type of regime, but I try to extract like the learnings, for example, and what are some of the key takeaways and the positives out of it. Definitely, I will say it was always my dream to study in the US. So I remember when I was a little girl, we got our first cassette player, which happened to have a radio feature that captured radio stations outside of Bulgaria. So one of them was the Voice of America. So 11 o'clock at night, I would turn in the Voice of America and listen so I can practice and improve my English, because it was always my dream to come to the US and study in the US. It was something, the US was that aspirational um, um, country for me. And eventually I'm grateful that I was able to make it happen. Academics was really the path for me to make it happen, because it was virtually impossible for our family to cover tuition for education here. But I'm very grateful for the opportunity that was given to me, and was really excited when I first arrived and in the US to come to school and be able to make that dream real.
And so that is where the name of your company comes from. DBA, Dream, Believe, and Achieve. Wonderful. Yeah, it all ties together and understanding that. Yeah. But I also saw that you were a corporate executive. So you lived that other American dream, which is, I would say, more how I grew up, with parents encouraging you to get your education and then work for a corporation and you would be set for life. Like the corporation would take care of you, right? Not true.
Yeah.
Well, you followed that path, right?
Yes, I followed that traditional path for many years, and I was brought up in a similar manner, as well as coming to the U.S., right? When you ask people what success looked like at the time, um, success meant to be a CEO of a Fortune 500 company. And so I started going down that path, and I don't regret it for any little bit, because first I was able to achieve one of my dreams, which was get good education. And then I get some really great experience working in corporate America. So I was climbing up that ladder until a few events of adversity, as well as looking around, I realized, I may be climbing the wrong ladder. And what I'm referring to are a couple of things. One is when
I don't mean to interrupt you, but this is new technology, and I'm tapping my ear.
Don't tap it again.
There we go.
Don't tap it again.
Okay.
Sorry,
When we tap the ear,
no.
the audio cuts from what we can hear from you. So
They call me Miss Technology.
Yeah, technology has its own mind sometimes. So it's
Thank you. Yes.
so I completely understand. But yes, I looked around and I realized I was climbing the wrong ladder, because I always like to think forward 1, 2, or 3 steps ahead and think of what's next. What is it that I want to accomplish next? And when I looked at senior and executive management, I saw people trading more of their precious time for money. And as I was climbing the corporate ranks myself, I experienced that to a large degree. And this is not something that I envision being glued to my work phone or laptop 24/7. Secondarily, there are a few other events of adversity, and some were large market events that you probably remember, like the Great Recession of 0809. There were also the Enron debacle, my old employer going through a number of restructures, and all of these events left a lot of people without a job and or without a retirement plan. So that scared me. That really scared me, and I thought, what if I'm next? Nobody's really guaranteed or precluded from experiencing this event. And so that's what caused me to take a step back and think about, well, what is it? I don't control corporate restructures. I don't control market events. I don't control the global economics, but what is it that I can control? And I think in those moments of crisis, we usually tend to fall back to our habits. And I wouldn't say that real estate was a habit for me, but that's when I thought, well, if I buy a rental or two, maybe I can build a small retirement nest egg. So if God forbid I'm on the street when I'm 60 or 65, at least I have something to fall back on. So I'm not 100% reliant on an employer or the stock market roller coaster, right?
Yeah, I would say that's probably a similar story to many people if they went through that 2008-9 or even the prior downturn. People do look to see. Excellent point. You really verbalized it well. I think people might go through those emotions, but you just really put it perfectly.
Yeah. And so you started off, as you told us, you had your education, I believe it was through the Kellogg School at Northwestern, right? And then you were with Wells Fargo for over 15 years. And now you started for over the last year with DBA Capital. So today, maybe you'd like to share us a little bit about where you are taking that firm and what the next year looks like for you.
Yes, happy to share. As Dream, Believe, Achieve Capital Group founder, it is my privilege to work with investors who are perhaps not necessarily looking to change jobs, but want to diversify their portfolios in addition to what they currently hold in the stock market, but again, don't necessarily have the time or desire to be looking for vetting, doing deep diligence, managing, and making key decisions on their real estate investments. So this is where I come into play, leveraging my former commercial lender background as well as my experience as an investor to, first of all, find really strong sponsors because I used to say in lending that people pay back loans and eventually properties, but you hope it's the people and cash flow first before you get to the property. And that concept very much applies to investing. It really starts with the people and their track record, how savvy they are, and how what systems, tools, and processes they have in place to operate the property. Secondly, I look at the market, making sure that the underlying market fundamentals are strong and aligned with the investment itself. And lastly, I do deep diligence on the numbers and the underwrite. And once that investment passes or checks all of my boxes, then I share it with people within my community, and they can join me in if they choose to. I personally like to invest in all of my properties and take a lot of pride in that. So really, I'm growing my portfolio and inviting other people to join me in along the way, and I help them with a lot of the upfront vetting diligence as well as the ongoing monitoring of the.
Of course, yeah. That's incredible. And I know you mentioned due diligence, underwriting, and for those people, those viewers who follow you online would know that you have quite a bit of experience and a presence when it comes to underwriting due diligence. Would you be able to share some of your tips, tricks, your insights for some of our viewers?
Yes, absolutely. When it comes to underwriting, I first like to start with the market, right? Because understanding the market and the historical trends is key in formulating the underlying cash flow assumptions. That's really the baseline. And without understanding or knowing that, the assumptions one can make can be either highly optimistic or maybe too conservative to a point where you're maybe declining every single deal. So understanding the market is key. And then after I start diving into the deal, there are usually 5 key areas that I like to look at, starting with cap rates. And I bring up cap rates first because they have a pretty potent impact on the valuation or the pro forma valuation of the investment. And for better or worse, that's cap rates tend to be typically driven by the markets, meaning not something that you can control. And for that reason, when I make pro forma assumptions on cap rates, I like to assume that the markets will get worse before they get better, meaning I like to see cap rate expansion versus compression. And then understanding the underlying assumptions around rents, expenses, is also key. Those, again, tie very closely to the market and sub-market, as well as the sponsor's historical track record. And last but not least, reserves. I like to say that there are a lot of things that can and will go wrong with a property, and unfortunately, you cannot predict anything and everything that will happen during the intended 5 to 7 year hold of the investment. That's why it's imperative to build a very strong rainy day fund up front. And I recognize that usually tends to reduce the returns, but it also reduces the risk profile of an investment. And last but not least, the debt structure. That's something I look at very closely to ensure it is aligned with the business plan. But most importantly, I like to see that the sponsors are applying some form of interest rate hedging, because that's one of the many risks we face as real estate investors. And I don't like to lose sleep at night worrying about where interest rates will be. So I like to hedge those and then shift my focus towards operations.
For sure. Yeah, it sounds like you take quite a bit more conservative approach than some of the other gurus might be talking about, where they talk, focusing on cap rate compression and how they can raise rents and not hedging themselves, as you're saying, on potential downside. So it's refreshing to hear an operator that's looking at it from a more conservative perspective. And that's great to hear. What would you say maybe to LPs that are listening that are hearing your conservative approach, but they've maybe been pitched by much more aggressive operators who promise higher returns, maybe tax opportunities, these sort of, very enticing opportunities? What would you tell those LPs in terms of looking at a sponsor?
It boils down to a basic a concept, which is trust but verify, or I should say verify and then trust. So make sure you ask a lot of questions to really understand the underlying assumptions that effectively go into deriving those returns on paper. Because I can make a deal look very, very attractive on paper, but it can flop from hero to zero very quickly if the underlying assumptions are not supportable and not in line with the market as well as the operator's track record. In most cases, I'm yet to meet an operator who wouldn't share their actual underwriting. And sometimes if it's a proprietary model, they may share the PDF of the model along with their underlying assumptions. But if they decline to do so, for me at least, that's a red flag. So I'm taking a look at the underlying, and at least, if nothing else, look at the 5 areas: rents, expenses, cap rates, reserves, and debt structure, to determine if the underwrite is realistic or optimistic. And then last but not least, when it comes to sponsors, really observe how they communicate, especially during those initial stages. If they're not answering questions or sharing information openly at a moment where they're effectively marketing, right, the investment offering to you, you can only imagine how they will be after the deal closes. So pay close attention to that, and always, always, always ask for a sample of their monthly or quarterly reporting, just so you can see at what level of details they're reporting and sharing information, and then determine if that's aligned with your expectations, because everyone is different. Some people are more high level, some are more detailed, and the reality is that reporting is probably somewhere in between. But take a look at that and then determine if that's in alignment with your individual investment style as well.
Thank you. That's incredibly valuable. I'm sure a lot of our listeners would love to hear all of that and taking in a lot of that advice. I guess to round off our interview and not hold it too long, what would be maybe some of your expectations over the next year? We hear a little bit of rumblings with the Fed doing small cuts. Obviously, we have a new administration coming in. Do you have maybe not a crystal ball, but some expectations that you'd like to share with us for the next year?
Absolutely. I think 2025 will be a pivotal year for so many reasons. One is the rate factor that you mentioned, which will bring in maybe a little bit relief when it comes to the cost of capital. I say a little bit because for a variety of reasons, and I can dive into more detail, but the long-term expectation is that we'll be in an inflationary environment, which will keep the long-term rates higher for longer, probably closer to their long-term historical average of 5.5 plus or minus %. So there will be some relief, but not too much on the cost of debt. But what is more intriguing for me is to see how the looming wall of debt maturities will be resolved. I think a lot of those deals where operators will be pressed to take action, either refinance a deal or sell a deal, a lot of those opportunities will probably be done behind the scenes, where operators with strong track records have established relationships with brokers and lenders. but there will be other transactions that will probably come on the open market. For me, and what I've learned over the past few years in up markets and down markets is to keep emotions aside and adhere to underwriting fundamentals. So I'm looking forward to curating more investment opportunities for myself and my investors, because I think deal volume will increase. But I'm also not looking to do that at all costs. And that rule has served me well, especially during some of the turbulence in the market, in the multifamily market that we're experiencing today. So my plan is to continue to adhere to that. Again, hoping to do more deals, but not at all costs.
That's great to hear. And I think we definitely agree, certainly with peak financing. We've seen a good amount of loan modifications already, and going forward, we certainly expect that to increase. So definitely behind the scene action in terms of properties being traded as they reach maturity and there's some distress. But I have a strong feeling within the next 12 months, a lot of those opportunities will open up to the broader market, which looks very promising.
Mm-hmm. Vessi, are there any other asset classes that you enjoy delving into, or is it really just multifamily?
For now, I stay in my lane, which is multifamily, both on the active and passive side. I did have one attempt to diversify in another asset class, and I say attempt because that didn't really end very well. And there was some very valuable lessons learned along the way. So for now, I'm adhering to multifamily, but eventually, if there is another asset class that I would look into, that will probably be industrial. My risk tolerance is not very high, so I tend to gravitate towards asset classes that have lower risk adjusted returns.
Makes total sense. And there's probably a lot of other people out there that might be wise to follow that same plan.
Yeah.
Are your investors mostly friends and family, or do you go out and source through social media?
It's a combination. I started with a lot of people within my immediate network, and over time they invited their friends and family. So people I had the pleasure of connecting with. And I'm also very active on social media, meetups, conferences, and through those venues, I've been able to connect with investors as well.
So very much how other sponsors are out there, kind of starting home with your friends and family and then branching out if the results are good, and then they invite their friends or their other family members. So that's great. That's wonderful. Yeah. Have anything else?
No, I know we've talked quite a bit offline with Vessi and through our other platform, Alternative Investors Network. And we've had a lot of great conversations, and certainly don't want to talk about all of that because some of those conversations are private. And if people want to know more about, the behind the scenes, some of the risks, they should join the community or talk to us. But, have these personal conversations if they want to learn really the in-depth, because as you were saying, a lot of investors have their bumps in the road, and that takes real learning experience. And so it's very valuable whenever you're able to share that with us. So
it's the one positive that comes along with aging. As you feel like, oh, I'm getting too old, now you have this entirely wealth of knowledge that you bring to whatever it is you're doing. And it's something to really be proud of. And much like what you see young people, I mean, we want them to succeed, of course, but you need to have life experience, business experience to be fully trusted. Right?
Absolutely. Yeah, it's those, I like to call them seminars, and sometimes you experience those directly through your own experience. And in other instances, you have the opportunity to learn through the experiences of others. So the Alternative Investor Network, that has been a great forum to connect with fellow investors and exchange ideas so we can all learn and grow together.
Yes, absolutely, because we want everyone to be successful, right?
Yes.
It's not about holding anyone down. It's about motivating and pushing forward, but safely with the right tools. And certainly your background, you've got the discipline, the way you were brought up and where you were brought up. You have the expertise in finance. So you're a sponsor that anyone could be happy to meet and engage with.
Well, thank you for saying that. I don't take that for granted, so I appreciate it.
Yeah. Well, Vessi, we're going to sign off here. It's been wonderful talking with you.
And, for those listening, what is the best way to get in touch with you, Vessi, if they wanted to set up a call to discuss about maybe DBA Capital or your underwriting, or just to connect?
Three easy ways. One is through my site, dbacapitalgroup.com. D as in dream, B as in believe, A as in achieve. If they would like to learn more about underwriting, I actually have a course on that for investors new to multifamily, and that's under masteringmultifamilyunderwriting.com. And on social media, I'm typically most active on LinkedIn, so people can find me there as well.
That's great. Thank you so much, Vessi. And we'll make sure that people get access to all the links on the back end when we edit this. But thank you so much for taking the time and having this discussion with us. We really appreciate it.
Sure to see you soon at the next event. Who knows where?
Looking forward to it. And thank you so much for having me on as a guest. I really enjoyed our discussion.
Always a pleasure.